All right, with all the housekeeping out of the way, I am very excited to introduce Brady and Michelle. Brady is a transactional tax lawyer with Jackson Walker in Dallas, where he's a member of the Tax Transactional and M&A Advisory Group. His practice focuses on the tax aspects of domestic and international transactions. Joining Brady is Michelle. Michelle is a licensed CPA in the state of Texas with more than 20 years of experience providing tax and accounting services to a broad spectrum of businesses and industries, executives, family partnerships, and high net wealth individuals. I'll give you the stars of the show, Brady and Michelle.
All right, yeah. My name is Brady Cox, and I'm presenting with Michelle, and I'm going to kind of give a little bit of some of the legal considerations on international income tax considerations on the inbound side, or we're not going to really be talking about any outbound considerations. This is more foreign investment coming into the U.S. And I'm going to, like I said, just kind of go through just an overview of some top considerations that you might think of when you have a foreign client or a foreign client involved in a transaction with a U.S. client of yours. I want to just give a disclaimer that this is not an exhaustive course on international tax. International tax is a very complex and very deep area of the tax code, and we are hoping with this course just to kind of give you an overview of some of the top topics that hopefully will help you issue spot. You're helping advise your clients so you know when to reach out to someone who has a little bit more experience. And I would say that's more so on the CPA side. I think reaching out to a tax attorney like myself that deals with international taxes is not, it's every time you have a foreign person, it's not always going to come up. It's usually only on very complex things. But someone like Michelle is someone you're definitely going to want to be in contact with when you have a foreign person involved in either your client or a transaction that involves a foreign person. So with that, like I said, here's a couple things I'll discuss kind of briefly. U.S. residency status. We're looking at are we dealing with a U.S. resident, and that's a foreign person that's a resident in the U.S., or are they non-resident? Income sourcing, is the source of the income U.S. or is it foreign? Income classification deals primarily with whether or not the income is coming from a U.S. trade or business or not, and there's kind of different ways those incomes are taxed. Also, what constitutes a U.S. trade or business, and when is a foreign person engaged in a U.S. trade or business? Some of the tax rates that are involved. Michelle's going to cover most of the compliance topics here, and then I'll briefly cover how tax treaties come into play, a little bit about the branch profits tax, how U.S. real property interest kind of has special treatment, and a brief estate and gift tax considerations. And this is just a brief overview, but we'll look at some structuring options that people are involved with commonly that we see on the legal side, and discuss some pros and cons of the different structures. So residency status, like I said, what we're kind of determining here is U.S. citizens and residents and domestic entities. They are subject to U.S. tax on their worldwide income. So you and I, all of us that are U.S. citizens, wherever we're earning income, the U.S. is going to try and, have a hold on that income and tax that income. A non-resident may not be taxed on all of their worldwide income. And we'll get into that on the sourcing test. That's why we usually start with this determination, is whether or not the person that's foreign, are they resident aliens or non-resident aliens? That's the technical legal term we use. A non-resident alien is neither a U.S. citizen nor a U.S. resident alien. So the main test is, what are we looking at for establishing when a person is a resident alien? The first is the green card test. That's pretty straightforward. Do they have the green card that's colloquially referred to? And if not, then we look at the substantial presence test. This is a days test. It's very mechanical. So we look at 31 days in the current year, and this you're looking at the past 3 years. So you're looking at 31 days in the current year. I'm sorry, the past 2 years in the current year. The number of days in the current year plus 1/3 of the days in the first preceding year, and then 1/6 of the days in the second preceding year. And if that sum equals or exceeds 183 days, you have substantial presence under the code, and you have now slipped into the main U.S. tax system on worldwide income. So that's where be careful in watching that if you've got a foreign person and identifying how long they have been in the U.S. Or the easier part is green card, but you've got these two. And we'll talk a little about tax treaties, and they can modify this, but this is the you test under the tax code. All right, so then I talked about income sourcing. So we've got to look at, is it domestic or U.S. source, or is it foreign source income? Now, this is important because unlike U.S. citizens and residents who are taxed on the worldwide income, non-resident foreign individuals and entities are largely taxed just on their U.S. source income. There are some exceptions for some foreign source income that I won't get into here, largely dealing with whether it's derived from a U.S. trade or business. But as a general rule, we're looking at U.S. source versus foreign source, determining whether or not the U.S. tax system will affect that. And a lot of income sourcing depends on the nature of the income or what type of income it is. So there's some examples here on this chart that we can look at real quick. Interest, it's generally U.S. source if the debtor, the person paying the interest, is a U.S. person. And there's some exceptions there for an 80% owned U.S. person, but I won't get into that, but to just be aware. And then outside of that, generally is considered foreign source income, and generally is not going to be subject to U.S. tax, but like I said, there are exceptions there, but you can that's the general rule. Then we got dividends paid by a U.S. corporation, same thing. It's U.S. source, other dividends, non-U.S. source. Personal services income, services performed in the U.S. versus service performed outside the U.S. is the kind of determining factor. And one thing to note here is a big thing that we're seeing now, and there are proposed regulations that haven't been finalized, is services that are done over the cloud, remote services, and where are those services being performed? That is kind of up in the air right now. That is something that they are looking at and trying to determine how that type of income should be sourced. So just keep that in mind, that is an open issue, and it is becoming more and more, especially after COVID and with the ease of technology being able to perform services remotely. That's going to become a major issue as we continue down this path. Rents and royalties is largely determined by whether or not the property is situated or used in the U.S. Real estate, again, we're going to talk about the FERPTA rules that deal with real estate, but generally, real property that's in the U.S. is going to be U.S. source income versus real property that's not. And then just be aware that with non-inventory, there are special rules for inventory property that I'm not getting into, but non-inventory personal property, it's like property that's generally other than IP and other than real estate. If it's looked at who the seller is, not looking at where the property is, but if the seller is a U.S. resident, U.S. source income, if they're a non-resident foreign source income. And this is largely the reason why sometimes a foreign person can own stock, and if they sell that stock, may be able to escape taxation because that's personal property that would be foreign source income. Now there are exceptions there. We're going to talk a little bit about that, but just be aware that's kind of how that works. Income classification. So we're looking at U.S. trade or business income. Is the income derived from U.S. trade or business, or is it what we call FBAR, which is slipping my mind, but it's income such as interest, royalties, kind of other income that's not U.S. trade or business income, but is still U.S. source. These are the two main categories of this income. Now the differences between them, it's fixed, determinable, annual, or periodical income. That's what FBAR stands for. But just think of it as, if it's not U.S. trade or business income, it's probably FBAR income, but there are some exceptions there. The large difference between these, U.S. trade or business income is net basis taxation. So you get to deduct, it's deductions versus income, just like, general U.S. tax principles. FBAR is on a gross basis. It's generally 30% of the gross amount of income. So no deductions allowed there. The other difference between these is if there's been proper withholding on the FBAR, there generally is not a filing obligation. But U.S. trade or business income, if you were engaged in U.S. trade or business, there generally is a filing obligation. And that applies even if you have a treaty. A big thing that comes up there is if you have a treaty that operates to take your income out of U.S. taxation, you still have to file a return to take that position with the service. That's a lot of times that gets missed. So just be aware of that. And then we'll just do a quick look at U.S. trade or business. This is the key determining factor in the taxation of non-residents and foreign corporations. You're looking at, is it FBAR or is it U.S. trade or business? Whether it's a U.S. trade or business is a facts and circumstances determination. It looks at several factors, including continuity and regularity of an activity, significance of the activity, increasing income, the nature and function of the U.S. facilities and personnel, the number of transactions. There's several factors they look at in determining that. It's not an easy, just like the substantial presence test is very mechanical. This is not a mechanical test. This is very facts and circumstances, and it can be very tedious to have to decide this. So we'll talk a little about that in our structuring. And like I said, so I would say with withholding, it primarily comes up with FBAR. It can come up in U.S. trade or business context. But I always tell people with withholding can be very dangerous if it's missed. It can flow through an entity to an individual who has check writing authority is the term we use. So you want to be very careful that your clients are properly withholding. So that's why I always say if there's a foreign person involved, whether it's your client or your client having a transaction with a foreign person, make sure you have somebody who has international tax experience look at that transaction and make sure your client, if they're not the foreign person, doesn't have a withholding obligation. So you don't want to miss those. And a lot of times those, if there is a withholding obligation, there's exceptions, there's things that can be done to avoid it, but you have to make certain filings, and just be aware that that is there and to watch out for that. Watch out for the branch profits tax. This is a tax that's imposed on foreign corporations that are doing business in the U.S. It's a flat 30% tax on what's called the dividend equivalent amount. It's generally their earnings and profits that are connected with U.S. trade or business, but there are adjustments. And like I said, FERPTA is the Foreign Investment in Real Property Tax Act that came in the 80s. It applies whenever you've got a foreign person The easy case is you got a foreign person that owns an interest in US real estate and they're transferring that interest. You've got to consider FIRPTA and how that's going to impact them. Especially if and that's a big reason why you'll see in closing transactions, you'll see one of the big closing deliverables is always a FIRPTA certificate or a certificate of US status, is because you generally need to get that so that the buyer does not have to withhold and submit money to the IRS. So we watch out for FIRPTA. One big thing to watch out for FIRPTA is if you've got a foreign person that owns stock in a US corporation, the regulations presume that that US corporation is what's called a US real property holding corporation. Even if it has nothing to do with real estate, the code and the regs presume that that entity is a US real property holding company. Sorry, that the stock, and it presumes that the stock is a US real property interest, not necessarily that it's a holding company. Forgive me for that. But it presumes that the stock is a US real property interest, and you've got to establish that it's not, and for purposes of these withholding and tax rules. So watch out for that. That it just because this corporation doesn't have any real estate, you've got to do certain things to make sure that that's established between the buyer and the seller. And there's, like I said, there's substantial withholding regime, very, very detailed withholding regime to try and make sure that this money is captured by the tax system before the foreign person leaves. So let's jump into a couple structures here. I've got a US LLC in the US with two partners, and that's primarily done there so that we can have a partnership for tax purposes. So we've got a US individual B, and then we've got foreign individual A. You know, we all know one of the big pros of a LLC and partnership tax is the flow through. There's no tax at the entity level generally. And there's a lot more flexibility to restructure than with a US corporation. You can move property out, you can move property in. It's a lot more flexible to move things around and change how you're doing things. For foreign people, one of the big reasons we do not do this structure is because the US trade or business that US LLC is engaged in typically is going to flow through to A. A is going to be seen as engaged in whatever business LLC is engaged in, and A is now treated as being engaged in US trade or business. Even though A may be a passive investor in LLC, that A will now have a filing obligation and be subject to, tax on US trade or business income. That's one of the biggest reasons we try to avoid this structure. Another big reason is US estate and gift tax is based on US situs. And so this entity would be treated as US situs asset, and now A is going to be subject to US estate and gift tax on that asset. So if A dies, A's ownership of that is now going to be subject to the US estate and gift tax regime. And then the other big downside with foreign person and US LLC is the LLC is going to have withholding obligations on income that's allocated to A. On the right side, we've got US Corp. So now we've got a US Corp in the middle of USL between A and US LLC. This has the effect of possibly blocking US trade or business. That's not a guarantee. There are ways around that, such as things like a sham corporation, or if you're not respecting the corporate identity, the IRS maybe just look through that, but we don't see that a lot. It's really just if you've set up the corporation and you intend to have it there, it's generally respected. So we generally call these blockers that block the US trade or business status flowing through to A. The other, as we talked about, the sale of stock may be exempt from US tax. A may be exempt from US tax on the sale of its stock in US Corp, but watch out for FIRPTA. That's always got to be watched out for. And downsides here, two levels of tax. We're going to have the corporate level tax automatically in the US. It's going to be 21%. And then it's still, we've got individual owning US asset, so still subject to estate and gift tax. So there's a downside there. And then here we've got on the left ownership of, all right, I'm sorry, that line is in the wrong spot. It's a foreign corp owning a US LLC. So now we've got not an individual coming in, but foreign corporation. Now this may escape US estate and gift tax because now you've got foreign corporation owning US asset, and estate and gift tax is not only applies to individuals, it does not apply to corporations. Again, there's always risk of flow through, or disregarding that corporation for whatever reason, but generally we don't see that. This also would allow some flexibility to restructure in the US, because on the LLC side. Now the foreign corporation is going to be the one subject to flow through taxation, but would have kind of a block there. And again, it would be blocked from the US trader business status, but branch profits tax is the big downside here. So you got to watch out for that. And finally, the structure on the right is commonly one of the most common structures that we use is foreign corporation into US corporation. Again, this has the effect of blocking that US trader business status coming up to A and the foreign corporation. So now you've got the US trader business stopping at the US corp level. Again, you come into the sale of the stock may be exempt from US tax by the foreign corporation or by A selling the foreign corporation stock. But again, be careful, watch out for FIRPTA. And then again, A is possibly able to escape US state and gift tax here because we've got foreign corporation owning the US asset. And finally, in the con side, again, we've got corporate level tax, still possibility of branch profits tax. Could be very costly to restructure these. So usually when we do set these up, we try to do it in a way that they understand that they want to leave it like this for a long period of time. And FIRPTA rules may still apply here. So those are some of the structuring considerations that we go through on the legal side, and some of the general considerations to think about when you've got a foreign person investing in the US. So Michelle, I'll turn it over to you on the compliance side.
Like I mentioned earlier, with the complexity of the international transaction, it is very crucial to understand the specific triggers for various reporting requirements. So in this session, you gain insights to avoid penalties through compliance of the most common foreign reporting forms and learn to manage the legal and financial challenges of international tax scenario. So like Brady mentioned earlier, there's a difference when we think about reporting in the US, mainly is whether you are a United States taxpayer, which is a US person, or you are not a US person. So with the US taxpayer with foreign assets or activities that are subject to certain information reporting requirement, you would need to understand those requirements and what their application is due to the penalty for failures or negligence to report. However, the IRS also offers favorable retroactive disclosure programs to taxpayers who proactively cure the previous issues to rectify prior omission. Therefore, I think it's very important for us to understand how is a United States person is defined. A U.S. person is, of course, a citizen or resident of the United States. Like Brady mentioned earlier, the resident could be considered through the green card or substantial present test, physical present in the U.S. A domestic partnership or a domestic corporation, any estate other than a foreign estate, any trust, if a court within the U.S. is able to exercise primary supervision over the administration of the trust, and one or more U.S. persons have the authority to control all the substantial decision of the trust. And that, and finally, very broad and inclusive definition is any person that is not a foreign person. So with a foreign person, of course, is non-resident alien of the individual. Opposite with the definition of the U.S. person, it also includes foreign partnership, foreign corporation. But also note that in general, the U.S. branch of foreign corporation or partnership is treated as a foreign person. A foreign estate, foreign trust is also treated as foreign person. So the first form that we need to look at, and it's very common, is the FBAR compliance. FBAR is the reporting requirement alongside with your personal and business federal tax filing. It's also applied to individuals and business entities that have offshore accounts. FBAR report is made to Financial Crimes Enforcement Network. It's called FinCEN at the Department of Treasury. And the form that we use to report is Form 114. It has the same deadline as your personal return, which is April 15, the following calendar year being reported, and extension of the personal return is also used to extend FBAR reporting. For the FBAR reporting, it must be filed by the U.S. person with financial interest in or signature authority over foreign financial accounts where the aggregate value of the accounts exceed $10,000 at any time during the calendar year. So if you have 3-4 accounts that is under $10,000, but aggregately is more than $10,000 at any time during the calendar year, you are subject to FBAR filing. Note that the reportable accounts are including checking, saving accounts, mutual funds, insurance policy with cash value, security accounts, future accounts, option accounts, etc. So there's a wide scope given to the definition of financial account. It's more than traditional bank accounts. So please please keep in mind that. Assets are not included in this FBAR is foreign real estate or interest in a foreign entity, which would be might be reported on a different form that we'll cover later. Financial interest is owner of record or holder of legal title or person with beneficial interest. So for scenarios that many taxpayer, if they try to shield tracing it back to the beneficial owner by hiding accounts, it will create problems and heightens the penalty exposure. The IRS will deem this is the willful intention to hide foreign offshore accounts, and the penalty is extremely high. It could lead to prison time. Financial interest is a U.S. person that has more than 50% interest in an entity. Foreign accounts held by the entity will be treated as beneficially owned by the U.S. person. So beneficial interest can also exist when a U.S. taxpayer employs a foreign agent to hold an account for them. Besides having financial interest, if you have signature authority, is also create reporting requirements for FBAR. So a U.S. person who is not the underlying owner of the account, but maintain the ability to control its disposition, is considered to have signature authority of the offshore account and is also subject to FBAR reporting. If you file the FBAR report for retention policy and to substantiate your reporting, you are obligated to keep a record of it for at least 5 years. Those records must be made available upon request if you are subject to audit. There are hefty penalties for non-compliance. It could be if you don't file a FBAR report or filing that is negligently inaccurate, the penalty is extremely high. If the discrepancy are deemed to be willful by the IRS, they are even higher, which is 100,000 or 50% of the account balance at the time of the violation, whichever is higher, for each year that a requirement FBAR wasn't filed. So for some cases, willful failure to file could end up in prison sentence. The same penalty applying to intentionally knowing, filing a fraudulent FBAR or false FBAR. The next form that's very popular as well is Form 8938. This is the statement of specified foreign financial asset. And normally this form is used to report interest in foreign financial accounts and foreign business entities. It is filed within the annual federal income tax return. Filed by a specified persons with an interest in specified foreign financial assets, and the value of those assets is more than the applicable reporting threshold. The definition of specified person, it could be either a specified individual or a specified domestic entity. Again, specified individual generally is this U.S. citizen and U.S. residents. So it's very important to understand the type of residency that you have in the U.S. Specified domestic entity is for closely held domestic corporations or partnerships getting 50% or more of income from passive sources, or where 50% or more of assets are held for passive income. This also include domestic trusts with one or more specified persons as beneficiary. The threshold for filing Form 8938 is vary based on the taxpayer filing either single or married filing jointly, and the taxpayer residence. Single filers residing in the U.S. must file their specified foreign financial assets exceeding $50,000 at year end or $75,000 at any point during the year. Married filing jointly, filers residing in the U.S. Has a threshold of $100,000 at year end and $150,000 at any point during the year. For specified individual residing outside of the U.S., the threshold are $200,000 at year end and $300,000 at any point during the year for single filers, and $400,000 at year end or $600,000 at any point during the year for married filing jointly individuals. Now, the definition of specified foreign financial assets, they are financial accounts that maintained by a foreign financial institution and interest in foreign entities and financial instrument with a counterparty who is not a U.S. person. Foreign financial accounts are any depository or custodial account maintained by a foreign financial institution, as well as any equity or debt interest in a foreign financial institution, other than interests that are regularly traded on an established security market, or any cash value life insurance of annuity contracts maintained by an insurance company or other foreign financial institution. Other specified foreign assets, including interest in foreign trusts or foreign estates. Specified foreign assets are the one held for investment, not held in connection with the taxpayer's trade or business. It is important to note that the Form 8938 is not a substitute for the FBAR reporting Form 114, and this form has a separate filing requirement. So most of the time, if people have the FBAR filing and they also have Form 8938 to file, the information from Form 114 is reported also on Form 8938. The next one is the very important form. Is called Form 3520, Annual Return to Report Transactions with Foreign Trusts and Receipt of Certain Foreign Gifts. Form 3520 is used to report certain transactions with foreign trusts, ownership of foreign trusts, and gift and bequests from non-resident. This form is separately filed with the service in Ogden, Utah, and it must include all of the required attachment to be considered complete. Following requirements for this form is primarily where the U.S. taxpayer has a connection with a foreign trust, if he or she either a grantor or beneficiary of the foreign trust, or a U.S. taxpayer cumulatively receives gifts or bequests from a non-resident exceeding $100,000 of a foreign estate treated as gifts or bequests of more than $17,339 from foreign entities. Responsible party for reporting a reportable event that occurred during the current tax year or transfer of property to a foreign trust or related party in exchange for obligation. Responsible party are grantor of the trust, transferor on non-death transfer, or executor in other cases. A U.S. person who during the tax year is treated as the owner of any part of the asset or a foreign trust. The reportable event, pay attention, is when you have a creation of the foreign trust by a U.S. person, when you have transfer of money or other property to a foreign trust by a U.S. person. A U.S. person, including the U.S. owner of an executor or an executor of an estate of a U.S. person who during the current tax year received directly or indirectly a distribution from a foreign trust, or it's also triggered at the death of a U.S. person treated as an owner of a foreign trust, or where the trust was included in the decedent estate. The penalty for this form is very severe for grantors and beneficiary of the foreign trust who fails to report, and it could create penalty up to 35% of the transfer amount. Late penalty may be reduced or avoided. Like I mentioned earlier, that the IRS have many programs, offshore amnesty program, to assist taxpayer with safely getting into compliance. And we'll discuss more about this later in the chapter, but remember the key is to discuss with your tax advisor and your attorney when you run into the situation of failure to file, and the attorney and the tax petitioner can help you to find a strategic solution so that you can stay compliant and not deemed to be willful violation with the U.S. with the IRS. The next form is Form 5471, informational return of the U.S. person with respect to certain foreign corporation. This form is very complex, so it is required by the U.S. person, shareholders, director, or officer of international foreign corporation who have an ownership interest or control, and normally is 10% or more of shares or voting power in the foreign corp and foreign parent equivalents entities. In most cases, the form is information disclosure. The information required to be disclosed depend on the category of the filer. There are 5 categories of filers. Typical disclosure, including information regarding to the shareholders, class, and attributes of issued and outstanding stocks. We also need to disclose the income statement, balance sheet, and current earnings and profits. All financial information must be in accordance with the U.S. GAAP. Extremely complex reporting, like I mentioned, with 5 categories of filer, and the Form 5471 instructions specify 14 different schedules, which must be filed based on applicable filer category. I will, there's many more. We'll hand out the handout for this presentation, so you can look into the 5 different categories by filers that applicable for Form 5471. The next form is the Form 8865, is the return of the U.S. person with respect to certain foreign partnerships. So Form 8865 normally look into the 10% or greater of interest in a foreign partnership or contribution over $100,000. And of course, it must be filed by the U.S. taxpayer with specified interest in foreign partnership. And also there are 4 category filers within this form. So again, it's also very complicated forms that your tax practitioner would be able to help you to navigate through each type of category filer and report the proper information on this form. There are also additional reporting requirements that other forms that are very popular as well that I want to mention is Form 5472. This form that you normally see when the U.S. corporation owns 25% or more of foreign taxpayers, is filed with the reporting corporation. The U.S. reporting corporation need to file this form, which will have a reportable transaction with the foreign or domestic related tax related parties. Form 8858 is filed by a U.S. Tax owners for foreign disregarded entities. So this form report ownership of a foreign disregarded entity and foreign branch while providing the IRS with financial information about the foreign companies. Another important form is Form 926. This form is filed by the U.S. person making cash property transfer to foreign corporations. If a partnership makes a transfer, each domestic partner must file Form 926 and report their proportional share of the partnership's property. The partnership does not need to file the Form 926, but must provide the pertinent information related to the transfer to each partner. So you see a lot of time that if you have a partnership investment, you receive the K-1, that it disclose information that the partnership make cash or property transfer to foreign corporation, you will need to pay attention and make sure that determine that whether you are obligated to file Form 926 based on the threshold. The cash transfers have special rules. Form 926 must be filed if cash is transferred to a foreign corp in the following circumstances, which is immediately after the cash transfer, the person directly or indirectly hold at least 10% of the total voting power or value of the foreign corporation. Or if the amount of cash transferred during the 12-month period ending on the transfer date is more than 100,000. So let's say if your ending transfer date is in June, we need to look at June of the previous year and June of the current year to see whether the transfer is more than $100,000. If you transfer securities or stock, then this form should be filed for transfer of security or stock when a gain recognition agreement is triggered. If you are a domestic liquidating corporation and making a property distribution as part of a complete liquidation to a foreign distributee corporation, you also need to fill this form. If you are a domestic corporation distributing stock or securities to a foreign control corporation, you will also need to file this form. Other forms like Form 1116 or Form 1118 is filed by the U.S. individual, a trust or state under Form 1116, and corporation need to file Form 1118 to claim foreign tax credit. And there are separate categories of brackets used for foreign tax credit, very complicated as well. Form 2555 is for U.S. expat to claim foreign earned income, exclusion that permit U.S. citizen residing and generating earned income abroad to exempt a portion of their foreign income from U.S. taxable income. So the criteria must be foreign earned income, and foreign earned income defined as salaries, wages, professional fees, and other compensation for your services. The tax home of the individual must be located in the foreign country. Individual must meet either the bona fide residence test, which means that they are resident of the foreign country for a complete tax year, or the physical present test, indicating that they are present in a foreign country or countries for a minimum of 334 days during the 12 months period. Now, as I mentioned earlier, the IRS offer many amnesty programs to help taxpayer who fail to meet the reporting requirements. There are 4 programs that the IRS put out there, which is the first one is the IRS Criminal Investigation Voluntary Disclosure Practice. It's called VDP. And these 4 individuals or the entities, the U.S. Individual and entities who knowingly and willfully non-comply with the reporting requirement. Another one is called the Streamline Filing Compliance Procedure for non-willful with reasonable cause entities and individuals that fail to file. Another one is Delinquent FBAR Submission Procedures and Delinquent International Information Return Submission Procedure. The IRS encouraged taxpayer to consult with professional tax and legal advisor to determine which option is the most appropriate for them. In most of the circumstance, if you plan well and you work strategically with the attorney and the CPA, they can choose most appropriate options, depend on the situation you're in to apply for the amnesty, and it could result in no payment a penalty to the service. But again, you have to work closely with our attorney and the CPA to develop a game plan. Otherwise, you might, if you pick the streamline, but then the IRS could come back and say, no, you are deemed to be willful, then the first option, the VDP, is going to be off the table. So it's very important to understand what is non-willful and what is willful in context. Streamline program, the submission requirement is normally 3 years of the tax return, 6 years of FBAR, and you have to have a reasonable cost statement. It's for, like, again, I said, it's for the individual for taxpayer who deemed to be not willful for violation. Reasonable cost has to be drafted very carefully, and I recommend normally it needs to be looked over by the tax attorney and the CPA to make sure the language, the reasonable cost that put in the application would be convincing and give the taxpayer the strong position to deem as non-willful. And so with this, when you run into the situation of knowing that you unintentionally not knowing that you obligate to file, I encourage you to contact the CPA and work with the tax attorney immediately to find a solution and be able to utilize the program that's appropriate for you. Well, that concludes my presentation. And now we go to the Q&A session. Hopefully, we have enough time left.